and Robert there have been pretty, and Charles have been pretty negative near term on the market. And, I continue to see more and more commentary, whether it's in print or whether it's on CNBC this morning, people being very cautious about valuations and where the market's trading at 22 times earnings on 2025 and looking for some sort of correction or pullback. That seems to be moving toward the consensus, which is interesting. You always, a lot of times want to go against the consensus, but it seems like consensus is moving more and more toward we need to see some sort of correction here, either in the first quarter at some point in 2025, given where valuations are. I don't know what you guys are thinking otherwise, but it just seems to be a turnabout, and then you wake up this morning and the market's up on the open, trying to continue that the gains that they had from last year. So I don't know what gives here.
I agree. I mean, you've definitely seen that change in the narrative and all the work. Now it's worries, can NVIDIA actually do what they've been doing? Like it's instead of, oh my gosh, this is going to continue, it has completely changed. I figure the market's going to keep ripping because I took off exposure late last year, not all of it, obviously, there's some exposure, and put in some hedges. So given my luck, that must mean the market's ready for another 20 or 30% move.
Well, it's interesting too, and I think, Robert, you pointed this out, that the move's been all concentrated in a handful of stocks. I was looking across, I do a lot of call option writing, and a lot of the industrials and cyclical stocks weren't up last year. Yeah. I think that the S&P, 40% of it's in 10 stocks, and that's what's driving everything here. So, yeah, you got to keep those Mag 7 or Mag 10, whatever you want to look at it. You got to keep them going. You're going to have some big rotation to get this market up again a third year in a row.
Yeah, the small caps had that flash of outperformance in the fall, I guess, and it faded in the last couple of months of the year. Russell 2000 pulled back, the equal weighted S&P. I think I did that report that showed the S&P median stock was up 10%, and a third of the stocks in the S&P were negative last year.
Yeah. So, is this AI momentum continue to drive everything again this year? I don't know. We'll see. I think energy does well. I think people start to, at some point here, start to anticipate the big move up in LNG demand and AI demand toward the end of this year. And it's energy was sort of out of favor much of last year. So we'll see what happens. It doesn't take a lot of rotation out of these Mag 7 names into energy to move the energy sector, given it's such a small percentage of the index. So
I agree. Energy is, if people are optimistic, they're optimistic on the Mag 7 and I said the mega cap stocks and the mega growth companies are all in favor. The Palantirs of the world and all that stuff.
Hey guys, just checking my audio real quick. Am I okay?
You're good. Nobody's pitching energy stocks. Good. They were all pitching energy stocks 2 years ago when it had its big run.
Yeah.
What's interesting, I've noticed also there's been a huge uptick in the stories of people wanting to see Bitcoin or MicroStrategy fall apart. I mean, our contributors are certainly on that as well, but it's actually really interesting wanting to see that collapse.
What does Trump want?
Exactly, that's a better question. Will there be a reserve or not? Well, let's get started. So welcome to Wall Street Beats. Today is January 2nd. I'm David Maris. We're diving into the markets with some top experts. Bob Morris, 7-time #1 oil and gas analyst, will break down EQT and EXE. Veteran stock picker Robert Marson will share with us why Weatherford made his portfolio. Kevin Baker analyzes the technicals on oil, gas, regional banks. Maybe I'll touch today on NMRA's news and the impact on biotech. Not good. Fun trivia fact as we begin. 50 years ago today, Bill Gates and Paul Allen pitched BASIC for the first Altair 8800, unknowingly kicking off Microsoft. And I don't know whatever happened to the two of them, but we should probably look into that, see how they did after doing that. So with that, why don't we start, Bob Morris, tell us what's going on with these two companies. I don't know them, and as someone who doesn't really traffic too much in oil and gas names, what do these companies do? Why are they attractive now, or why are you buying them now?
Yeah, these are the two purest natural gas E&P companies in the sector. They're 96, 98% natural gas, and they're the higher quality names, in my opinion. You've got Antero and Range Resources behind them. Antero and Range have a lot bigger liquids component to their gas mix, but these are all natural gas focused names. And people have been watching the gas focused names after a horrible year last year, just on the fact that natural gas prices tanked early in the second quarter just because of a warm winter. And so, as we've been watching these names here into this winter, so far it's been a warm winter, but all of a sudden, last Sunday, we got a revised forecast that it's going to get frigid cold in the Northeast here starting in about a week. And that lit a bit of a fire under natural gas prices, which have run up here. And Monday, Tuesday of this week, after that forecast came out on Sunday, most of these gas focused names are up on average around 4%. And so, we're watching these names because I own EQT in mid November. We started building a position there. I want to own more. Haven't bought any EXC, Expand Energy, which is the old Chesapeake, which is really interesting because it pays a decent dividend. And I think a lot of people just haven't paid attention to it or recognize what this name is now, having come out of bankruptcy as Chesapeake and now being a totally different company, having merged with Southwestern and being a pure natural gas play here. And what we're looking at is, you got a 4% move up in these names early in the week. You've got this frigid weather coming in. But, I'm being a little bit careful watching the technicals because then the weather's supposed to go back to warmer than normal for the full winter. And we sort of had this last year where prices ran up late January and then natural gas prices came off as we went into the spring when we looked past that cold snap. And if you look past that cold snap, the March futures contract at $3.10 is a lot lower than where we are in the February contract now at $3.70. So what's my point here? It's hard to predict the weather, and that forecast sort of surprised people last Sunday. Provided a little bit of momentum to the gas names, and so right here I'm watching them. I want to add the EQT, and I'm looking for any dip or pullback. There's good support at 42.50. I'm trying not to be too cute and wait too long, and I do have a position. I have some exposure, but I don't want to chase him here either. But I am sort of exposed to Mother Nature. If it continues to be wicked cold throughout the rest of winter, these names are going to continue to run. But they're names
Bob,
you want to own
for a quick second. EQT and EXE, just again to get very basic, are they pumping natural gas out of the ground and then selling it, or are they sort of a middleman that's doing something else? Are they running pipelines? What exactly?
No. They're purely at the wellhead. They sell it. They sell it at the wellhead. They drill the wells. They produce it. They basically sell it at the wellhead. EQT does have some midstream, they transport it, but they're selling it at the wellhead. They're just producing it and selling it. That's what you call E&P's, exploration and production. Unlike the integrateds, Exxon, Chevron, that actually have then downstream operations and refineries and all that sort of stuff.
So now I think it was a Morgan Stanley report recently that said EQT is really a power play on AI. I didn't make the connection. They did some sort of 10-year deal or something with different power suppliers. If they do a 10-year deal, first of all, does that even make sense to you? Can you explain that? The other is, if they are doing a 10-year deal, are they locking in the price, or are they just saying, hey, listen, we'll do the spot price. You're now our customer?
No, what they did is they sold a piece of, or 50% of their regulated business to BlackRock. So it was just a financial deal. They took in $3.5 billion to pay down debt. So it was purely a financial deal because they wanted to sell down their interest in some of their regulated pipeline businesses. So that's all they did. And so are they an AI play? Absolutely. Because you're going to need natural gas to power all these AI data centers, hands down. And that's, you've got different forecasts, but a lot of these forecasts are for a big, big uptick in natural gas demand to power these data centers, particularly starting later in the second half of this year. You're not going to power these data centers with nuclear or solar or wind anytime soon. It's got to be natural gas. And that's the big bull play long term on natural gas is, one, the AI data center demand, into the LNG export demand with some new LNG export facilities coming on later this year to ship natural gas around the world again for power, particularly if Russia is going to be cut off from shipping gas into Ukraine and what's going on over there. So EQT, EXE, yes, the big bull case long term people are looking at now is the data centers. That's the top of the list as to the bull case for EQT and EXE, yes.
Got it. All right. Is there anything else you want to add
I
on those two?
I have a question for Bob. So natural gas is, as you pointed out, strong for the next couple of months, and maybe we can make a lot of hay then. But as you pointed out, the March futures contract is closer to 3. I looked at the strip yesterday, and like April and May might even been in the high 2s, 280, 290. Yeah. So to explain to the viewers, natural gas is not going to drop from 3.5 or 4 to 280. It's priced at 280 now for that month. So you can't forecast the price is going to drop. That's where it is, baked in. Now, that 285 could rise over time, and when it becomes the near-term contract, could be 350. But the point is, that's where this commodity's priced today. If the strip plays out exactly as it's configured today, what do you think happens with the natural gas stocks in 3 months or 4 months?
They're not going to get shellacked. And if you look, it's interesting. If you look at what happened last year, and that's what played out. What you're talking about in the strip is, gas price actually played out even worse than that because we dipped down close to 250 in the spring.
Went to $1, right? It went to 190 or something. I think. Go ahead.
Yeah, and if you look at the chart last year, EQT that had gotten up to 42.50 in the spring, in the summer dropped down to 30. I don't think it's going to go back down that far. There's been a lot of value created in the name since then. That's why, I'm being a little bit patient here, but what could happen to the gas names if that strip plays out and we're at 280, come March, April, May, you could be down to 35. I think that's the bottom. I think that's as bad as it gets. You may not get down to 35 because at that point, people begin to anticipate then looking out toward the end of the year, these AI data centers and LNG facilities come online. That's why I worry about being too cute. I think, the worst case scenario is EQT dips to 35, but if it dips below 40, I'm adding to my position here. And, I'm looking at EXE. If I can get it back, I don't think it gets maybe to 90, but if it does get in the low 90s, that's where I'm going to start picking it up too. But, a year ago you had a record warm winter, you were chock full of gas in storage, and people had no place to go with the gas. Remember, what drives natural gas demand is that the peak demand is in the wintertime. And why storage is important is that the amount of natural gas we produce is more than what demand is in the summer. So we take that excess supply and put it in the underground natural gas storage, because then in the winter, demand is far more than what we can produce. So we supplement that production by pulling natural gas out of storage. And that's why people watch storage so closely, because if we come out of the winter with a lot of gas in storage, we don't need to run as hard to refill it then going into the next winter. And that's what happened last year. That's why natural gas prices collapsed, is we came out of the winter after a record warm winter with record storage levels. And everybody said, well, until next winter, we don't have to run very hard to refill storage. And as a result, a lot of these E&Ps shut in production. They shut in over 4 BCF per day, or over 4% of production, in the U.S. was shut in because nobody wanted to take $2 or $2.50 for their gas.
So they still have lots of capacity that could be ramped quickly. I remember you telling us about that too. Some of your favorite ones.
Yeah, I think all that 4 BCF per day of shut-in production is back online, and that was shut in, and some of these drilled but uncompleted wells are being brought back online here now too, and they can ramp up. If all of a sudden they decide, gas is going to be $3.50 to $4 from here forward, they're going to step up the pace.
The market's handling that new supply. It appears it needs it now, right? So
right now it's just cold winter. Yes.
So Robert Marson, let's talk now about Weatherford. I thought for a second before I looked them up, they make the liners for the inside of cars and things like that. But that's a wholly different company. What do they do exactly, and why do you like it here? I looked at the chart. It looks like a scary chart up until recently. So tell me about it.
That's my thing, buying scary charts, David. So I think I bought a lot of scary charts in the last year on this show. So that's what I do. They would have had a better year last year if they made plastic floor liners. That's for sure, as a stock, because they're in the oil service sector, and that had a terrible year because oil didn't do well, and the sentiment, natural gas did poorly, and the sentiment towards energy stocks was poor. And these things are like Chevron and Exxon on steroids. They have a beta of 3 compared to the big integrated producers, so they go up a lot more and down a lot more based on sentiment and commodity pricing. They're a global, truly global IP leader in drilling and production and well analyzation and all that kind of stuff. It's a conglomerate that was put together by a prior management team over a couple decades, and they were run for deals and run for acquisitions and run for size. And they blew out the balance sheet and it went into bankruptcy, got a kick-ass new CEO who brought in a very talented team to restructure the business. And they sort of sold off or closed other businesses that were their commodity businesses and just kept where they had their very strong IP. So they winnowed down the company. I think they probably lost 2/3 of their sales, but the third that they kept was really strong IP. And they have a very strong portfolio of leading edge technologies in all aspects of producing oil and gas. It's 80% international. Their biggest customers are customers like Aramco and Pemex, and the global national oil companies are their biggest customers. They only have 20% again of their revenues in the U.S., and a lot of that's fracking related. Some of it's short cycle, but some of it's offshore too. So it's a long cycle business. When they get a contract to drill, it's not a 30-day well. It's a 5-year deal to produce a field. That's how they operate. That's their business model. So the stock had a huge run coming out of bankruptcy. It became vulnerable to what I call a profit-taking panic. And it hit 135 from maybe 23 years ago. And I expected it to drop a lot. So I started circling in the mid 80s. I did a 1% position. Which, when you're in a 1% position, Bakesy, you cheer for a bad stock because 1% ain't going to make me any money if it goes up, if I bottom ticked it. So I decided when it went to 68 last week on tax loss selling, I bought 2 incremental percentage points. So now I'm in with a 3% position, which is not a big position for me, but considering energy is already over 1/3 of my portfolio, it's more energy. And I don't need more energy. I did it despite not needing more energy because it was too good a deal to pass up.
And is energy being such a big part of your portfolio based on the underperformance for a long time? Is it based on AI power play? What are you basing that on? Or is it, no, it's just, it turned out that way after looking at individual stocks?
Yeah, it's some of it's the latter, but I really have 2 portfolios: a growth capital portfolio and an income portfolio. And in the income, I don't have any fixed income. I have MLPs, all the pipelines that you asked about, the companies that process the gas and separate between the gas and the liquids and ship it and store it and all that kind of stuff. So the MLPs, I've talked about all of them here, from Energy Transfer to Enterprise Products and PAA, so Plains All American. So that part of my pipeline, that part of the portfolio, the pipeline part, is sort of fixed for income. So I kind of hold those forever, and that probably makes about 25 to 30% of the portfolio, and the other 10% is individual stocks like Select Water, Chart Industries, and now Weatherford. Two oil service stocks that, despite the problems with increased efficiency in the oil service, had marvelous years last year. My 2 big energy service plays. Weatherford is I consider that the start date on that last week when I got my cost basis down to about 73 and change. So we'll see how.
Hey, Robert, quick question on Weatherford. Since they're 80% international, for this stock to work, how much of it is dependent on new exploration discoveries for them to drill and develop versus international companies like Saudi Arabia and Exxon deciding to spend more money going forward to develop discoveries they already have in hand?
Yeah, I haven't seen a breakdown of exploration versus production, but I'm pretty sure I haven't seen them like on their slide deck and in their docs. I didn't see that breakdown, but I'm pretty sure they would be more production weighted because they do have a whole division that is artificial lift and reservoir extension. So for me, it's going to be more production related than exploration related, I would say. I don't know the exact weights. And again, the efficiency gains in the oil patch are definitely, you know, not not helping the oil service sector. And these guys, when I bought the stock, maybe they had a 5 to 10% forecast for sales growth, and the numbers have been shaved a couple times, so they're now down to flat to low single digit growth this year. I don't think the growth is going to crater unless oil goes down to $40 or $50. Then I would suspect the income statement to take a hit and then the numbers to be reduced not insignificantly. But I'm not betting on $40 oil either.
But this is a highly oil levered play. If oil goes to 80 to 100, then people are going to develop more of their fields or discoveries they have, and they should be
Yes.
a big beneficiary on a lot higher beta to that development.
Yeah, Bob. And I actually think for these companies like Schlumberger and and the companies that don't have the swing cycle in oil production is the Permian. They're the short cycle. Capacity comes on, comes off, and you could be booming 1 month and 6 months later be not drilling anything because of oil prices. The When you develop a billion barrel oil field offshore somewhere, that's a 5 to 7 year development process. That doesn't consider daily fluctuations or monthly fluctuations in oil price. Once you start those major projects, they come on no matter what, and they produce no matter what. And you remember, I think the world loses 5% of its 6% of its oil every year to depletion. So if you're doing 100 million barrels a day, you got to find 5 or 6 more million barrels a day of production. The fracking in the Permian is like manufacturing oil. It's not conventional oil production, and they're the companies that have the most negative exposure to the efficiency gains in the oil patch. This is not one of
Well,
them.
Marcin, you were talking about income before, and that reminded me of CNQ. Bob, CNQ is now at a 5% plus dividend yield.
Oh,
Are you adding to that? Because I think
I
I'm
was
going to.
I was adding to it 2 weeks below 30. I was like pounding the table on this stock when it dipped below 30 um, back 2 weeks ago. So it's like a 5.2% dividend. That dividend is safe. They increase the dividend every year for like 22 years, including when oil went below $20 a barrel. This is a unique company. So yeah, it's up here at 31 and change. So yeah, like I said, I'm not adding to it today, but when it dipped below 30 2 weeks ago, yeah, I was pounding the table on it.
Yeah, David, when I did my oil or my natural gas, let's call it midstream companies 3 years ago, I think I was buying them at a cap rate, a dividend yield rate of about 11 to 12%, and it's now up to over 13% cash on cash. So I don't do I don't do stuff unless it's conventionally very depressed. So I'm looking for extreme you know dislocation in assets. For me, I would never buy a 4% common stock for yield because the average yield is what, 1%. That's ridiculous for me. Not for guys that run billions of dollars. That's their job. They have to find income ideas. But the midstream business, it wasn't supposed to be a growth business 3 years ago, but no one knew about AI. And yes, as Bob says, there's going to be a lot of new natural gas power generation constructed in the next 5 years in this country, and demand is going to boom for natural gas for that purpose.
Maybe we should do a show next week just on our top dividend plays, and that would be an interest. I'd like to hear from you guys about. I mean, I know obviously CNQ, but remind everybody of the midstream players that you're in, Marcin and the rest. So the two Roberts, and maybe we'll get a couple others on for that. Speaking of,
Hey, David, just keep in mind on CNQ too, they're the second largest natural gas producer in Canada. People forget that. So they benefit from the AI play too. And They get a big boost if Canada became the 51st state too. So
Exactly.
David, where we were talking before the show began for the viewers now about oil and energy had a pop a couple of years ago. Warren Buffett made his famous buy of Oxy. By the way, I criticized it in real time. I have a tweet to show. I'll post it on the chat.
I
But
just want to be on the record because he is getting up there in years. I've never said anything negative about him, and if he's looking for people to bequeath things, remember, I never said anything negative about him.
I have called out hypocritical actions multiple times in the past, starting 25 years ago. So anyway, energy had a big glory day period for 6 months where everybody on CNBC talked about buying energy, and I was only 3 or 4% of the S&P, and then it faded out with AI. And I think the call this year would be the stocks does poorly, and the energy ETFs do really well. That would be the big surprise for 2025. And things might be teed up for that if oil could figure out a way. And I don't know what the reasons would be. I was asked earlier by Bakesy, what could get oil to 80 or 85? I don't know. Maybe just inventory. Saudi says they're not going to increase production for the next 2 years, but the oil markets are not as oversupplied as the talking heads say. And we all know natural gas has a very bullish story, starting the end of this year into next year. 26 and 27 would be boom years for natural gas demand. So that's a good thing. So maybe these energy stocks are, going to give us a contrarian move this year versus expectations and outperform the market and outperform the tech stocks.
Yep. So you mentioned Bakesy. So for subscribers and for viewers who are wondering who that is, Kevin Baker goes by Bakes, technical analyst. He was going to be on today. We're going to get him on tomorrow. We had some technical issues with his audio. We didn't want to put you through that. So we'll cover the technicals on the names that we mentioned today, the oil and gas stocks. So make sure you tune in for that. I just wanted to mention that there's a company, NMRA, Nomura Therapeutics, down 88% today, a biotech company that was looking to develop an antidepressant. And guess what? They had some data today. And for people who want to try to play the guessing game, was it good or bad? Pretty easy, down 88% in a day. So and you might say, well, okay, then maybe it's a small cap or tiny cap stock. This had a billion, nearly a $2 billion market cap before today. Now, is that weighing on biotech? Absolutely not. Actually, the biotech index is up just under 2% this morning. Now, I'll talk about later, probably next week. I added to biotech. I told you that I brought down healthcare exposure in the fourth quarter. I added a little basket of some biotech companies, a somewhat random basket too, because I think that the biotech index is probably oversold. Now, we have lots of reasons to be worried about that. So I think that I made this a very, very small basket to kind of get started. And so we'll see how the new Trump nominees work out and the rest. But with having underperformed for the last 5 years, the biotech index is essentially where it was 5 years ago. I'm wondering if we've flushed out a lot of the IPOs and the not ready for primetime players that went public in the last couple of years, and maybe the market's now getting a little bit more discerning. But we'll leave that for another day. I want to thank everybody.
David, let me ask you a question. You want to buy the ETF? Do you feel like it's just too much of a gamble to pick individual names or stocks? Be more of a stock picker in biotech and just buy the ETF, or do you have favorite biotech names?
Yeah, so I'm not I generally pick individual names. For if someone said, look, I have no exposure to this sector, I don't know it at all, I don't want to spend the time doing that, I probably would say, yeah, that's fine. You'll see it's just so cap weighted, and really in biotech, you're kind of playing the takeouts and the new generation of science. Some of the big caps are in that, but when you have an Amgen or a Biogen in that, it's kind of unlike NVIDIA or Microsoft, where they're kind of cutting edge still. in the areas that they want to be, or that they have giant cash flow. Some of the bigger cap companies, while they might have cash flow, they're not on the cutting edge, some of them on the science, so they have to acquire it. So I generally look at the things, but I think you're probably right. The reason I did 10 names is to try to duplicate a little bit of margin of safety that you get with larger diversification. So you're probably right. I'm probably better off just buying the ETF and not worrying about individual names.
Hey, David, I pitched my one biotech stock in a portfolio that I on a show here maybe a month ago. But if you're looking for something that's got 100 bag potential, it's CLGN. It's a $50 million Israeli, the company that makes it grows human recombinant collagen inside tobacco plants, and they have breast replacement scaffolding and derma filler. They have a deal with Allergan.
Yeah, I think you had mentioned this. If I remember correctly, they have are they the ones with the deal with AbbVie?
Yes, the deal with, I said Allergan, but AbbVie owns Allergan.
Yeah. So as everyone who might know Botox, that was made by Allergan. AbbVie acquired it, and they're the number one in dermatology or cosmetic dermatology, and so they know what they're doing. I definitely want to take a look at that and maybe get in touch with them. I know that you're pretty close to them, so I like companies that have deals with leading companies. I don't mean it as like a blank check, like, okay, just definitely do it. But a company that has so much riding in that space is going to do their due diligence. They're not going to just say, oh, let's give some money and let's have a failure. Now that happens sometimes, so that's why you don't just blindly do that. But I definitely do want to look into that in the first.
Take a look at the website. They have a slide deck, and it'll spend 10 minutes on it. It'll get you interested or not.
Absolutely. All right. Well, thank you, everybody. We'll see you tomorrow on Wall Street Beats. And if you're interested, I would, to get our chat, get our written reports, go to wallstreetbeats.com, sign up, subscribe. You can even get a 14-day, 30-day trial, something like that, and check it out. But you'll get even more of us, which is usually a pretty good thing. Thanks, everybody.